Hello, and welcome to this evening's event. With so many of our members sheltered at home and unable to really meet person to person, we're trying to connect all of our members with experts in the area of investments and to provide some education and guidance on how to navigate in these stormy waters we're facing today. I would like to thank Ryan for being our producer tonight. Ryan is head of community affairs. He leads our local chapter efforts. He maintains and puts together a program for the investor conference. And now he's in charge of our e-events that we're doing, such as these webinars. And he'll be monitoring the question panels for any kinds of questions that might come up as far as technical resources are concerned. And he's actually being joined tonight. And Annie Prada is assisting him as a producer tonight. So if you have any technical questions, they'll do their best to get those to you. And as our offices remain really closed as well, we're doing a shelter in order, shelter in place situation here in Illinois. Really the best way to reach us for any kind of questions is through our email process. And if you email members@aai.com, that'll get to our member services, and they'll be sure to route any kind of questions that you might have to the appropriate party. So my name is John Bykowski, and I'll be the moderator here tonight. And I'll be listening and watching the various questions that come up in the questions panel of the GoToWebinar window, and I'll relay them to our speaker tonight. And I'm excited. We have a very good speaker tonight, and I'd like to welcome Derek Hageman.
Thanks, John. It's great to be here. I'm excited any chance I have to talk about dividends, so looking forward to the webinar.
You know, I understand that you grew up in Minnesota and actually attended college there, but you studied not only finance but also French. And how did those two connect you in today's world?
That's true, and thanks for bringing that up. And I see in the background over your shoulder, it looks like you did a Minnesota tribute tonight. I don't know if people can see your posters in the back, but I see Purple Rain, Prince's album, and to the left, I see Bob Dylan, so two of the best-known Minnesotan singers. And to answer your question, yeah, finance and French, I've always been interested in both. And, you know, with the hopes of always meeting a French-speaking woman, and actually that's exactly what happened. My wife is French-Canadian, so my French definitely paid off.
Oh, wonderful. And actually, I guess after you finished your first tour of college, you actually did something very interesting job. What was your first experience in the world as far as being a paid professional?
Yep, it was definitely an interesting first job out of college. It was, as the slogan goes, the toughest job you'll ever love. It was actually a Peace Corps volunteer, small business development in Senegal, West Africa. So I actually lived in a small village and helped work on a village banking program. So I got to use my finance, and French is actually the official language of Senegal. So I got to use both of my undergrad degrees.
That's wonderful. I remember we kind of joke about you because in the office, you know, you're known as our deep value guy. You're kind of the junk man. And I mean, I know you did some work in private equity before coming to the association. You did a lot of analysis. How did you come to love looking at distressed companies and cheapo stocks?
Well, thanks. I actually wear that with a badge of honor. I'm a huge fan, as many of our members are, of Warren Buffett. My favorite investing slogan is, you know, be fearful when others are greedy and be greedy when others are fearful. And it just speaks to my love of looking for opportunities that I think are undervalued, and doing the fundamental analysis on those stocks, or whether it was for private equity, looking at opportunities to increase value. So I've always enjoyed value investing, and that's another reason that I enjoy managing the dividend investing portfolio, because it naturally has a tilt towards value stocks.
Well, that's wonderful. And I guess I have one more warning. I guess I want to give both, perhaps, to our audience here, and you know, and maybe even to anybody living in your house right now. You know, with us being working from home and doing out of conference calls during the day, I've occasionally heard a fire siren or two coming from your house. Anything people should be worried about if they hear any fire sounds coming out?
Yeah, I'm glad you pointed that out. So yeah, you probably won't see any pets or young children entertaining you in the background today, but there may be a fire engine or two, because I actually live across the street from a fire department, so I'm sure it will happen tonight. So apologies beforehand. And also, if there are any Chicago fire lovers out there, the television show, I actually live very close to Lottie's Pub, which on the show is actually called Molly's Bar. So it gives you a little reference of where I'm speaking to you from today.
Well, I look forward to when we're actually free from shelter at home and we could lift a glass of Malort over at the pub.
Don't remind me of my initiation to Chicago.
Very good. Well, I'm sure our audience is really looking forward to your presentation. I'll let you take over, and I'll be monitoring the boards for questions.
Okay, great. Thanks, John. Okay, great. Let me get started here. So again, thanks for joining the webinar tonight. Like I said, I'm excited to talk about dividends, and I hope all of you are staying healthy and safe in these challenging times. Again, my name is Derek Hageman. I am the editor and financial analyst for AAII's Dividend Investing service. And tonight I'm going to be talking to you about seeking dividend safety and aristocrats in a volatile market. So with that, I just want to talk about some of the learning objectives for tonight. I'm going to be talking about the benefits of dividend investing. I'm going to be going through an introduction to the 3 pillars of dividend investing. It's a framework that we use at AAII. I'm going to talk about S&P 500 sector analysis and EPS growth expectations. I'm going to touch briefly on the CARES Act and the impact that it may have on income investors. And I'm really going to drill into the financial strength. That's actually the 3rd pillar of the dividend investing pillars. And then I'm going to focus on some dividend-focused ETFs. So that's the agenda for tonight. Planning on about a 45-minute presentation with obviously questions along the way. So with that, we can get started. I always like one thing before I get started, because I know this happens frequently when I'm speaking at chapter meetings or at the conference. People will usually be politely listening, and then as soon as I mention a ticker or an ETF, that's when people start frantically writing down. So I'm just going to cut to the chase and just give you a heads up. There is an appendix to this presentation. So if you actually go forward to the appendix, you will see some lists of tickers. Now, they're not my recommendations, but these are lists that were put together by investment firms. And I just wanted to share them with you, and they may provide you with a starting point with ideas so that you can do further due diligence on. So hopefully you'll all stay for the webinar though, and we will get to those slides. So there are lots of studies that are done that show that dividend growth may be a key to outperformance. So I always like to start off my presentations with just why are we talking about dividends? Well, I think this chart does gives a great illustration of why dividends are important. And this chart was put together by Ned Davis Research, and it can actually be found on Hartford Funds. There's a link at the bottom of the screen if you want to click on the report. And it really was a study done from 1972 through the end of 2019, and it breaks dividends down into different groups. And you can see the top one, and that's really what we're going to be talking about tonight. That's what dividend investing portfolio focuses on. That's what many of these ETFs that I'll be talking about tonight focus on as well. So they're called dividend growers and initiators. And you see that there's also a category called dividend payers, no change in dividend policy, dividend non-payers, and then finally dividend cutters and eliminators. And what you can see here is that dividend growers and initiators, it's historically provided a greater total return with less volatility compared to companies that cut their dividends. So you can see that the average annual return for the dividend growers and initiators has been 12.87% from the period 1972 through 2019. And you can see that dividend non-payers was only 8.57%. And we got these better returns in these studies with less volatility. So the next slide is benefits of dividend investing. Now, there's a lot going on this slide, and there's several benefits, and each one of these could be a topic on its own. I just wanted to touch on a couple of them. The first one, passive income. Dividends provide a steady flow of passive income, which you can choose to spend or reinvest. Third, it's the dividend investing has attributions that inflation protection. So unlike bonds paying fixed income, many companies increase their dividend payments each year. And five, even though less volatility than other stocks. Now, I know in the most recent bear market, there was indiscriminate chaos across every sector and even quality companies. But typically, dividend paying stocks have less volatility than other stocks. And dividend payers, they tend to be large, financially strong companies with more mature businesses, and they typically are less susceptible to economic cycles. And really, they provide a cushion against market risk. So dividend income has the potential to cushion falling prices and reduce volatility of returns. So those are a few of the benefits of dividend investing. So next, this is the three pillars of dividend investing. And this is really the framework that we use for dividend investing service at AAII. And we use a quantitative approach to dividend investing. We analyze over 40 different characteristics when making additions to or deletions from the dividend investing model portfolio. And we have found that these proprietary metrics have worked well for us over the long term. And I'll just touch briefly on the first pillar is valuation. So stock prices tend to fluctuate between high and low extreme valuation levels. And these relationships can be used to determine a stock's value range. And the primary valuation metric that we use at AAII is the dividend yield. And typically we look for buy signals when the current yield is greater than the 5-year average yield. And a sell signal is typically when the current yield is less than the 5-year average low. Now, I can talk about the first pillar in more detail on a future webinar, but I really wanted to talk about the focus of this one is pillar number 3. But before that, just a quick note on pillar number 2, which is growth trends. And a company's success is really driven by its ability to generate sales and convert that revenue into earnings and cash flow. And really, with the growth trends, you're just seeking to answer, does the company have the capacity to grow its dividend? And has it been growing its dividend? And does the company consistently pay its dividend? But like I said, for tonight's conversation, I wanted to focus in on financial strength. And there's the first siren, so one down already. The financial strength and quality, really we're seeking sticky dividends. And that's why investors like dividend paying stocks. And to analyze dividend sustainability, that's what we're going to do. We're going to look at a few key metrics later on in the presentation. So, we get lots of questions about which sectors may be attractive in volatile markets. And if you watched Sam Stovall's webinar from last week, it was called Prelude to a Post-Pandemic Pop. The next 2 slides, they're going to look familiar. If you weren't able to attend the webinar, it was a very informative presentation. And Sam is the Chief Investment Strategist at CFRA Research, and he's really a market historian. Now, what this shows is that typically there's traditional sector rotation during bear markets. And you can see on the left-hand side that from the period February 19th, which was the bull market peak, to March 23rd, you can see that the sectors, consumer staples, healthcare, communication services, some of the defensive industries that you would suspect, they, defensive stocks do well on a relative basis. And in this case, they lost less than some of the other sectors. So those are some of the sectors you might look to during bear markets. And on the right, it's again, it confirms that defensive stocks like healthcare, consumer staples, utilities, they typically on a relative basis do better than some of the other sectors. So really, bear market sector rotation, it does provide a good historical context. And this one, it's a bit of a busy slide, and no one really knows how long the market volatility is going to last. Will it be a U-shaped recovery? Will it be a V-shaped recovery? Will there be a second wave of coronavirus infections? How effective will the fiscal and monetary stimulus be? No one really knows. These are unprecedented times, but it is helpful to have a historical context. And really what I want to focus on is just the last column in green that shows the 2020 EPS estimates. And you can see again that just the top four utilities, again, the defensive and technology sectors, they may present opportunities in a volatile market. You can see that even though their EPS estimate growth expectations have declined, they still are positive for the year. Next, I just wanted to touch, because we do get a lot of questions on the CARES Act. And I just wanted to touch on it briefly. So the CARES Act stands for the Coronavirus Aid, Relief, and Economic Security Act, and it was passed on March 27th. And what it is a $2 trillion aid package, which provides aid to families and businesses impacted by the coronavirus. Now, the section I want you to focus on is the section in blue. There is a part of the CARES Act that contains $500 billion in business and local government lending. And it's important for dividend investors because companies receiving federal assistance from this $500 billion pot of money, they will be prohibited from paying a dividend for a period of time. And there's really no way to predict for certain which companies will accept the stimulus package. And it's difficult to know how companies may adapt their dividend policies for other reasons as well. But again, we're going to talk about some metrics that will hopefully give us some insight into which companies will be able to sustain their dividend during this period and in the future. So again, companies receiving federal assistance, they will be prohibited from paying a dividend for 1 year up until the point where they pay back the funds that they access. So it's 1 year that they can't pay a dividend or they can't repurchase shares. All right, on this slide, this is what we're trying to avoid. As dividend investors, we hate to see when companies suspend or cut their dividends. And I mean, we're already seeing this. Companies are also starting to withdraw their quarterly and full year outlooks amid all the uncertainty. There's also intense pressure from companies to preserve cash due to the impact of the pandemic. And there are several actions that companies can take to increase financial flexibility and preserve cash. Cutting the dividend isn't necessarily the first choice. They can reduce labor or operating costs. They can lower capital expenditures. They can draw down on revolving credit lines. They can suspend share buybacks. And as a last result for a lot of these companies, they can cut or eliminate the dividend. And what we have here is just a few of the industries that have been impacted initially. The airlines, we all know that with shelter in place, people aren't traveling. We've seen cuts or suspensions from Boeing, Delta. In the energy sector, they've had the double whammy of coronavirus impacting demand, while at the same time there's been a price war and an increase in supply from Saudi Arabia up until recently. And there's been cuts from Apache, Occidental Petroleum. The same with hospitality. We've seen it with Marriott International, Darden Restaurants, and in retail as well with Macy's and Nordstrom's. And really, dividend investors, they should be ready for further cuts and suspensions. Not trying to scare you, but according to Bank of America, analysts during the financial crisis, they did some analysis, and S&P 500 companies, their EPS declined 50%, and more than 80 companies cut their dividend during the financial crisis, with the biggest dividend cutters coming from financials. Now, large banks are in a much better shape than they were during the financial crisis, but you're even seeing it, the impact on financial institutions. A lot of them have announced suspension to their share buybacks, but they are continuing with their dividends and expect them to continue with their dividends as well. So let's move on. Again, for tonight, I want to focus on financial strength and quality, and we'll get into some of these characteristics that we analyze. And again, we're trying to answer the question, can the company sustain its dividend in the future? So with financial strength and quality, we're trying to understand a company's underlying financials, really their ability to generate cash flow, pay their obligations, and return capital to shareholders. And this really does tie into dividend sustainability. Can the company support the dividend in good times and bad times? So some of the metrics that we look at, the payout ratio, there's an earnings payout ratio, and there's a free cash flow payout ratio. We look at financial strength. High leverage generally is bad. Long-term earnings growth, because dividends are derived from earnings. And we look to see if companies have a long-term competitive advantage. So we look at margins as well. So we really are seeking sticky dividends. Can a company sustain its dividend? So to analyze this dividend sustainability, we look at a few key metrics. And here's a couple on your screen. There's the earnings payout ratio. These really are simple calculations, but they're powerful as well. They give us a lot of insight into sustainability. So the earnings payout ratio is the dividends per share divided by earnings per share. And the free cash flow payout ratio is dividends per share divided by free cash flow per share. And as you can see, we have the definition of free cash flow. It's the cash from operations minus capital expenditures. And the earnings payout ratio, it's how much of a company's earnings are being paid out as dividends. That's what that ratio is telling us. And the free cash flow payout ratio, that helps us answer the question, does the company still have money available to pay a dividend, retire debt, and repurchase shares? So here's some generalities on payout ratios. Generally, lower is better because it shows room to grow the dividend. High payout ratio, greater than 100%. It's not sustainable over the long term. And it's really important to compare to the industry and historical average. And I do have a slide on that in a couple slides that gives a look at what the median payout ratio is for different sectors. I typically get that question when I'm presenting to local chapters. And the one thing about the free cash flow payout ratio that's important is it's less easily manipulated by management. So it's really a good idea to look at both of these metrics. So on this slide, I wanted to go through just an example. and did an example with Walgreens Boots Alliance and Medtronic. These are two holdings that are part of the Dividend Aristocrats, and they are actually two holdings that we have in the dividend investing model portfolio. So you can see the calculation for Walgreens. It's 46.2%. That's under 50%. It's pretty much in line with their historical average. So again, they have room to grow their dividend, and in fact, they did declare a dividend today. They announced a dividend declaration, and they've raised their dividend for 44 consecutive years. Now, Medtronic, they declared a dividend on March 9th, and they've had 42 consecutive years of dividend increases. And you can see on both the metrics, they're reasonable. There's no red flags here, nothing to get alarmed about. As well on the free cash flow per share, 30.2%. It's very reasonable, leaves money available to pay the dividend, repurchase shares if they want, and to pay down debt. Now, like I said, I usually get this question a lot. You know, it's hard to, if you just saw the payout ratio for Walgreens, it really doesn't tell you much, but that's why this is helpful to look at what the median sector payout ratio is. Now I apologize, this slide is a little dated. It is from November, but you get the idea. It's still more or less around these numbers. And one thing I wanted to point out here is it really does depend on the industry. You can see that some cyclicals, they can be lower, 35.6%. It's one of the lower median payout ratios on this slide. Whereas if you looked at a utility company, 62.2%, that might give you some pause if it were in another industry. But that's one of the great things about utility companies. They have stable, predictable earnings, and so they can typically pay out a higher ratio. Now, I did receive a question before the presentation on utility companies, and one asked, you know, utility companies should typically do well in a market like this, and I agree, they are great defensive plays. The one thing that maybe why you have seen some utilities go down is that they were trading at very high valuation multiples leading up into February 19th. And even though they do have stable earnings, they will get impacted as well just from businesses you know, being shut down, factories closed, there's less demand for energy, and they continue to have large capital expenses to be able to provide power. So, and on this slide, I think it's always good to show an example of a company that does have a few red flags. So I'm sure many of you are familiar with Mattel. They're the creator of Barbie and Hot Wheels, and they really have struggled over the last few years, and really it's related to the Toys R Us demise, and they still really haven't recovered. And as savvy investors, like you guys are, you would have noticed that with payout ratios greater than 100% and negative free cash flow, the dividends just, they're not sustainable over the long term. And if you would have sold before the demise, you would have been really well off, because since Mattel cut its dividend, they did cut their dividend as a result of, you know, you could see in 2015, payout ratios greater than 100%, negative free cash flow, same thing for 2016, same thing for 2017. You can see this is just not trending in the right way. And they ultimately did cut their dividend 60% in June of 2017, from 38 cents per share to 15 cents per share. And they did that for a couple reasons. And one was it freed up $50 million per quarter by not paying the dividend. And the share price through yesterday's close is still down 61% since the dividend cut. So it's had lasting impact, and they just haven't ever recovered back to the pre-dividend cut levels. And today they are no longer paying a dividend. Now, I don't know, John, if you have a few questions, now would probably be a good time to take a few, if any have come across.
Bring myself back on here. Sorry. Yeah, a number of questions have come up, and you've actually done some good job of answering some of them. I have a question here from Mr. R. Welch. Some companies have dividend yields that are well into the teens now, and how do you analyze the cash flows for these firms to see whether or not they're sustainable?
Yeah, it's a great question. So there is a relationship with dividend yields and share price, and they are inversely related. So typically you'll see a dividend yield increase as a result of the share price going down. And some of these have a high yield because they deserve it. They are more risky. They aren't typically, now this is generally speaking, they aren't as high in quality as some of the dividend growers and initiatives. But again, you look at, even with the high dividend yielders, you want to look at these ratios, and you want to look at some of the underlying fundamentals of the company. Do they deserve to be priced that way? So I think those are a couple things you can do with some of the high dividend yielders. And that's not to say that high dividend yielders are all lower quality stocks. There's plenty of great high dividend yielding companies like REITs and MLPs that pay a high dividend yield, and they're great. It's just you have to look at the underlying fundamentals and use some of the metrics that we presented from the three pillars of dividend investing.
A number of investors have written in here, and they've looked at you did an article back in November regarding dividend-focused ETFs, and they're wondering, if you have any updates on that or that element. But I think that's coming up in your presentation. Is that correct?
It is, absolutely. Yeah, I did write an article, like you said, in November 2019 for the journal. It was looking at dividend-focused ETFs, and I do see this question a lot. So you can see the slide on the screen. I'm going to get into that. I did look at three different dividend-focused ETFs, and I can get into that in a moment after a couple more questions.
Here's a question here regarding there seems to be a greater emphasis recently, the last few years, on share buybacks versus dividends. So how has that changed how investors can analyze companies, and are there any ways to consider both, or how to equate both?
Yeah, no, that's a great question. As a dividend investor, I do like both, now that it is return to a shareholder. The one thing to keep in mind with dividends versus share buybacks is that dividends are a commitment by the company. Once a dividend has been established, they really hate to cut it or suspend the dividend. And typically you can see in the Mattel example, when they cut their dividend, it immediately impacts the share price. And as opposed to dividend share buybacks, that's something that the company is not always committed to. It changes year by year, and they can stop that at any time. So I definitely prefer a solid dividend that is consistent and sustainable. And I don't know, John, if you want to add something as well. I know you worked on the dividend investing portfolio for a long time as well, so feel free to add your insight as well on that. That question.
I think the additional point, and I know you've been working on this topic as well, is the whole notion of how can you combine the analysis of both dividend payments as well as share buybacks. And there are some tools. I know that you could look at things like the buyback yield, which looks to see how much the shares outstanding figure has dropped And you've even, I know you're working on an article, and I guess I don't want to, tease our audience too much here, but I know you're working on an article in which you take a look at a ratio called the shareholder yield. And why don't you tell us a little bit about what the shareholder yield is, and if it's been proven to be successful based upon testing of people such as O'Shaughnessy and Favor?
Yeah, definitely. No, I am working on shareholder yield for a future screen to hopefully develop for AAII using MEB Faber, the shareholder yield. I don't want to give too much away. I do want to hold back some suspense, and maybe it will create a webinar in the future. I could have a webinar dedicated to shareholder yield. But really, it looks at those three metrics. It looks at dividends. It looks at share buybacks as well.
Yeah, it is actually shareholder yield is a component that we use now in our revised value score. So it seems to have people like O'Shaughnessy have done some back testing. So dividend yield works, buybacks work, and you can combine the two with the shareholder yield to equate that. But obviously they're all effective tools, and at the association we try to be kind of agnostic. We don't really, we try to look for any advantage that we as individuals can have when it comes to selecting stocks that are attractive.
Yeah, and one thing just with the shareholder yield, you've already seen a lot of companies announce that they have postponed or suspended their share buybacks. So again, you've seen that with the banks in the UK. You've seen a lot of banks suspend share buybacks and cut their dividends. But shareholder yield is a metric. It has proved to have good performance over the long term. So we'll definitely be touching on shareholder yield more in the months to come.
And then one last point, I guess, before you continue on with your presentation. I know that you've looked at things such as not only cash flow, but even cash on hand. And nowadays, when you have a turbulent time such as this, where all of a sudden you have this really surprise shock to the system, where cash flow is sometimes quickly stopped, having access to liquid assets such as cash or being able to borrow is a big positive component for companies. So I know that that's also something you look at when it comes to companies in the DI portfolio.
Definitely, and AAII does have a screen called Cash Rich Firms, and it does relate to dividend investing as well, because you want companies that do have cash on hand, that do have strong balance sheets to get through these turbulent times. And so definitely you want to look at the balance sheet. Is it strong? Do they have cash? And what their debt levels are as well.
Well, I'll keep monitoring questions. I see them popping up on the screen, so we'll be sure to leave time at the end of the presentation to answer some more questions. Thank you.
Okay, sounds good. So I'll just pick up on this next slide. So like John said, we do receive a lot of questions from members wanting to know more about dividend-focused ETFs. So especially in times especially in terms of dividend sustainability. So I looked at a sampling of 3 dividend ETFs. I looked at the ProShares S&P 500 Dividend Aristocrats. It's ticker NOBL. I also looked at the Vanguard Dividend Appreciation Index ETF. That's ticker VIG. And I looked at Schwab US Dividend Equity ETF, and that ticker is SCHD. And for each of these, I looked at the portfolio stats. I looked at portfolio composition. I looked at return metrics. And then I wanted to look at sector breakdown, and I wanted to look at the top 10 holdings that each of these ETFs have. And the information for this comes from AAII's A+ Investor. A lot of it comes from Morningstar, and then it comes from the respective ETF family websites. So for example, ProShares, you can go to proshares.com, and there's fact sheets and there's a prospectus on everything you want to know about the ticker NOBL. But I do want to give you a few highlights. And so The ProShares S&P 500 Dividend Aristocrats. I know a lot of you have heard that name. You might not know exactly what it is. So I'll give you an overview here. And it focuses exclusively on the S&P 500 Dividend Aristocrats. These are high quality companies that have increased their dividend for at least 25 years. So that's a high hurdle to pass. And the strategy, it has been getting lots of talk lately. There's been lots of articles because it is a strategy that's demonstrated a history of weathering market turbulence over time by capturing most of the rising markets and fewer of the losses in falling markets. So it's very applicable to the market environment right now. So some of the portfolio, well, actually, first I just want to talk about the holdings. They generally have stable earnings, solid fundamentals, and a strong history of profit and growth. So just to give a little history about the Dividend Aristocrats, the first list was started in 1989, and it was comprised of 26 companies. In 2001, the list rose to 64 companies past the criteria, and then it did reduce to 52 companies by the 2008 financial crisis. And in the aftermath of the financial crisis, the number of Dividend Aristocrats, it actually fell to 43 companies by 2009. So it is a good starting point for people seeking dividend sustainability, but it has been impacted as well. There have been a few of the holdings that did have to cut their dividend, but in general, they're strong companies. They've increased their dividend for 25 consecutive years, and they just have a solid history. Their names, as you look down the top 10 holdings list, the majority of those are household names: Procter & Gamble, Johnson & Johnson, Colgate-Palmolive, Walmart, and Clorox. So, and another thing to note about the Dividend Aristocrats is, they have had the ability to operate through several boom and bust cycles during a 25-year span. So a company that's able to do that, they must have some competitive advantages. They might have unique products or service, they might have a strong management team, etc. So just a couple observations on the S&P, the ProShares S&P 500 Dividend Aristocrats. It's an equal weighted fund. You can see as you look at the top 10 holdings, they're all roughly the same percentage. And the fund actually gets rebalanced quarterly. It gets rebalanced in January, April, July, and October. And one of the criteria is that no single sector can exceed 30% of the group's total market cap. So it really doesn't have that many characteristics to be included. It has to increase for 25 years, and it has to be a member of the S&P 500 index. A couple of the big differences between, if you look at the sectors that are included here, there's a breakdown. And if you look at the S&P 500 sector weighting versus the sector weighting of the Dividend Aristocrats, a couple things jump out at me. The first thing is that for the S&P 500 weighting, tech is around 25%. Whereas in the Dividend Aristocrats, you can see that technology made up 0% of the fund. It's a big difference between the S&P 500 sector weightings. The other thing I notice is that industrials, for the S&P 500 weighting, industrials is around 9%, and for the Dividend Aristocrats, it's 22.5%. So again, a few differences between the S&P 500 sector and the Dividend Aristocrats. So a few other observations. So it's a lower weighting, which has actually been good given the fact of what's happened to a lot of energy companies with the price of oil. And if you think back to the earlier slides from Sam Stovall, if you look at the sectors that have performed better or worse in bear markets, you see that energy has typically performed worse. So in this case, the fact that Dividend Aristocrats has low sector weighting to energy, that's a good thing. And consumer defensive now at 22.8%, that's a good thing. So you can see a lot of the consumer defensive are part of the top 10 holdings. You got the Clorox, you got Walmart, Colgate, Palmolive, Procter & Gamble. And one other thing to note is that the sector weighting is low to utilities at 3.4%. And if you flip ahead to the index or the appendix at the end, there is a complete list of the holdings in the Dividend Aristocrats, and it's on slide 27. And there's currently 64 companies that qualify. So next, I just want to touch on the Vanguard Dividend Appreciation Index ETF, again, ticker symbol VIG. And I can let you guys review this slide on your, at your leisure, but there are a couple observations. First, again, the majority are household names. You got Microsoft, Walmart. Again, you see Procter & Gamble, Visa, Johnson & Johnson, McDonald's, Medtronic, very common household names. And the fund for the Dividend Appreciation Index Fund, the fund requires its holdings to have increased their dividends for 10 consecutive years. So a lower hurdle than the Dividend Aristocrats, which was, again, 25 consecutive years. There's a lower expense ratio compared to the Dividend Aristocrats. You can see it's 0.06%. And again, I got a lot of this information from AAII's A+ Investor Tool. I got a lot of information from Morningstar and from the ETF family website as well. What else can I say about the Vanguard Dividend Appreciation Fund? It's market cap weighting, so you can see that the top 10 has a higher percentage, 37.5% versus the Dividend Aristocrats, which was 19.2%. Here you have 182 holdings that make up the Vanguard Dividend Appreciation ETF versus 64 for the Dividend Aristocrats. Some of the positives here you have, if you look at the sector fund percentage, so for energy, they had 0%, which obviously was good, again, based on what's going on in the energy sector right now. There is some exposure to technology at 12.1%. Tech, even through these turbulent times, tech stocks have done well. And one other thing to point out, that for this ETF, the yield is 2.03%, so a little lower yield versus the Dividend Aristocrats, which is 2.66%. And you can see the annual performance going back to 2015. And again, all three of these ETFs, in fact, year to date through yesterday's close, they are negative, but they are performing less bad than the market as a whole. So it speaks to the fact that it has less volatility and it does protect some of the performance in down markets. Next, I want to go to the Schwab US Dividend Equity ETF, ticker SCHD. And this fund targets high quality, higher yielding dividend paying US stocks. Again, like the Vanguard ETF, the fund requires its holdings to have increased their dividends for 10 consecutive years. And it tracks an index focused on the quality and sustainability of dividends, exactly what we're talking about in volatile markets. So it does look at sustainability of dividends. And again, I can let you review the slide at your leisure, but a couple observations. It targets higher yielding dividend payers. Its yield is 4.03%, which is pretty high when compared to the other two ETFs that we talked about. It has no exposure to utilities. It has a little bit higher exposure to energy at 6.2% versus the other two ETFs. And it does have higher tech exposure at 18.1%. So it is a little bit more in line with the S&P 500 index weighting. I think that's a positive for this fund. So as you look at the top 10 holdings, they make up 45.3% of the fund, and there are 97 holdings in total. So again, this is a market cap weighted fund. They have tilted to companies that they think are going to outperform, like Home Depot, ExxonMobil, maybe not, but Intel, Pfizer, PepsiCo, a lot of these defensive names. All right. Do you have any other questions, John, that have come across before I talk about the AAII Dividend Investing?
Oh yeah, a number of questions have come aboard here. Let me turn myself back on here. Well, actually, a lot of questions have really focused in on what's considered a reasonable dividend yield to look at nowadays. And I did some quick examination here. If you look at the stocks that are in the Dow 30, the median dividend yield for those stocks is 3%. The median buyback yield is 2.3, and so on net, like they're basically paying a shareholder yield of 5.9%. If you look at the S&P 500 stocks, the median stock that's in the 500 has a dividend yield of 2.3%. So, with one stock has a yield as high as 17. So as an investor, I mean, do you set a minimum floor? How do you determine what's a good yield to look at when you're analyzing a company?
Definitely. You try to meet so in our case for AAII Dividend Investing, our benchmark is the IYY, and the dividend investing portfolio, our portfolio yield right now is 3.5%, and the IYY, I think it's around 2.3%. So that is one of the first hurdles that we look at for the dividend investing portfolio, is we want to be beating our benchmark. So in this case, we are by about 1.5 points. So that's one of the criteria we look at.
And so I guess also when you say like a company A, IBM, do you look at its own history to see if the current yield is attractive? Do you try to compare, IBM to Microsoft, or are there any clues you can give to individuals as far as, when is a particular yield for a company attractive?
Yeah, definitely. That's in our first pillar when we talk about valuation and whether the valuation is attractive or not. So absolutely, so in this example, IBM. So we look at the current yield, and history is usually a good guide, and so we use a 5-year average. So we will compare it to its historical average. And again, we look at the dividend yield as a buy signal and a sell signal. And just as a reminder, a buy signal is if the dividend yield is greater than its 5-year average, and a sell signal is if the dividend yield is less than its 5-year average. So we look at the company, and we look at the industry median as well. I think there is some insight to gain from looking at some competitors, just to see what their dividend yields are as well.
So there's a rumor that energy prices have come down recently. And I have like Ken here wants to know, obviously, lower energy prices is perhaps harmful to some industries and potentially beneficial to consumers and other industries. Do you have any tips or ideas on what industries might benefit from lower energy prices?
Yeah, so just on that, not to make light of it, but I wish I had a bigger house right now. I'd be storing barrels of oil. They'd be paying me to store those. But no, all joking aside, I think for energy there needs to be a balance somewhere between that $40 per barrel and $60 per barrel. It's just at prices, below 20, it's very devastating for a lot of the U.S. producers, especially in the Permian Basin, and for companies in North Dakota as well. I mean, they're already reducing labor costs. Many of them have cut their dividends. They're really in cash survival mode. They've cut capital expenditures, but at the same time, there are industries that benefit. Airlines, once folks are able to travel again, they benefit. Consumers, yeah, when you're driving your car, it's cheaper at the gas station to fill up.
So this truly is an unusual situation, though, because normally I think there used to be a rule of thumb, basically a drop in gas prices was almost the equivalent of a tax refund for investors. But with so many people sheltered at home, it's even hurt I guess the retail establishments that might benefit from extra cash on hand. But it's an interesting situation.
Yeah, and no, absolutely. It's a good point. And if you think back to the slide earlier on some of the companies that have cut or suspended their dividends, you saw retail, the Macy's and the Nordstroms, and you saw hospitality. There was the Darden Group, so restaurants like the Olive Garden and other brands that I can't remember off the top of my head right now. But yeah, absolutely, it's impacting retail and hospitality right now.
This is a bit more of a technical question, but do you have any recommendations? Someone's wondering, is it better off? Maybe you personally, do you have any thoughts as far as when a company pays a dividend, taking the money in cash or reinvesting it immediately? Because a lot of brokers offer that option now.
Well, it really depends on an individual's financial situation. I know lots of investors that live off the income, so they take the dividend as cash, where others, maybe they have a longer term horizon, and there really is that compounding effect. And I know it's been written about in I think it was a book called The Single Best Investment, where he talks about the power of compounding, where you reinvest your dividends, and those dividends create more dividends, and it's a glorious cycle. It really depends on the person's individual situation. I know, and one of the reasons why dividends matter to me, I like to tell the story that growing up, my dad worked for United Parcel Service, so they're a strong dividend payer, and at that time in our family's life, we use the dividend income from UPS to take summer vacations. So every time I see a UPS truck, now it puts a smile on my face, because I associate dividend income with spending it on summer vacation. So it really just depends on the individual's situation.
And it even might depend on whether or not you're holding the assets in a tax deferred account or a taxable account. I know it's become easier now, because a lot of times your brokerage firm will tell you when you sell your shares whether or not what's the taxable cost basis on those, and whether or not you elect to use average cost basis or a specific lot. But that was sometimes kind of a challenge, is to keep track of all the little dribs and drabs potentially of all the various odd lots that would occur when you were doing the automatic reinvesting. Another question here, if you don't mind. I have a gentleman here, Jerry, who is, he's I think in his 70s, and he's wondering, how prudent is it? He's got, money potentially coming in from a number of different sources, but if he wants to simply take a chunk of money and set it aside into something like the Dividend Aristocrats and not look at it, is that something reasonable for people to consider?
It is something reasonable for people to consider. As opposed to actively managing your portfolio, you put it in an ETF, and you have some confidence that they have a long track record of success. These companies have, again, a track record of paying dividends for at least 25 years, and many of those have been paying dividends for over 40 years. And if you want to feel even a little more comfort, I have a slide in the appendix called, there's a grouping called the Dividend Kings. Now this takes it to a whole nother level. These are companies, I think there's 30 that pass right now, and I got the list from a dividend website called Sure Dividend. And these 30 companies, their number one requirement is that they've paid dividends for at least 50 years consecutively. So there's currently 30 companies that pass the Dividend Kings screen right now.
I have a couple of questions regarding, I guess, the taxability of dividends. I mean, one of the benefits, I know that one of the reasons why companies started to emphasize payment of dividends again is because in the context of qualified dividends, they're not taxed at a higher income rate. They're taxed basically at the same rate as capital gains. When you own a mutual fund and the fund itself owns qualified companies that pay qualified dividends, as an investor, the question is, can you also then treat that income, dividend income from a mutual fund, as qualified?
I believe the short answer is yes. Not sure I can elaborate on it anymore at this point.
That's my understanding as well. But I know normally when you get your brokerage statement and you get the the various tax forms at the beginning of the year, which I guess we'll have to pay by midpoint of this year,
right.
They'll indicate what portion of the dividend payment is a qualified dividend and whatnot. So yeah, normally the answer, I think, in that context is yes. But obviously, we're not tax accountants here. You always want to consult a tax specialist beforehand. But my experience is in terms of actually reporting my own dividend, my own tax income on is that stuff does follow through or carry through. And I guess a question on slide 24, and I want to remind everybody here, first of all, that we are recording this presentation, and everybody who registered for the webinar will get a link to the ability to see the download. And also on our website, there's a section called events, and we have a link there for upcoming as well as past events. But a question on slide 24 here. Of course, I've lost my place because I have more questions that are scrolling here. But I'm sorry, I've lost my question. How about that? How didn't you love that?
It's all right. You're doing a great job handling multitasking.
Thank you. On slide 24, what does curated mean on the slide?
Curated.
24 curated dividend paying stocks.
Yeah, so that basically is a fancy word for hand-picked. So, and if you don't mind, I can talk about this in more detail. I did want to, obviously I'm the financial analyst and editor for the dividend investing model portfolio. So I just wanted to talk about the differences and maybe some of the similarities of the dividend investing portfolio versus the ETFs that we talked about earlier. But first, just what is the AAII Dividend Investing Service? Well, it is a model portfolio. We use real capital. It's 24 hand-picked dividend-paying growth stocks. We use the 40 proprietary characteristics that are part of the 3 pillars of dividend investing to come up with the portfolio, the ideas and the companies that we ultimately add to the portfolio. We alert members of portfolio additions and deletions. There's a monthly dividend investing newsletter. It has market commentary. It goes into, it focuses on 4 of the 24 DI model portfolio companies in depth in each of the monthly issues. And on the back, obviously there's always an educational component to everything we do at AAII. And on the back, we call it the back page. There's just investor education having to do with dividend investing themes. So we'll talk about The payout ratio, we'll talk about the importance of free cash flow. And then there's also, as a part of the service, there's a weekly email and commentary, which we talk about. We give news on the companies in the portfolio. We alert people to important dividend dates, so which companies have declared, have they increased, when will the dividend be paid, information like that. There's also a dividend article archive. AAII Dividend Investing, it started in 2012, so there's access to every article, every weekly commentary, every monthly investing newsletter going back to 2012. So it's a rich archive, and there's a website dedicated to the AAII Dividend Investing. There's also a section, it's relatively new in the last year. It's called DI Ideas. These are other stocks that pass our screen, and they're ideas that are quality companies. They've increased their dividends for at least 7 consecutive years. They have strong earnings growth, dividend growth, strong balance sheets, generate free cash flow, but they just haven't been added to the dividend investing portfolio yet for one reason or another. But they are quality companies, and they're ideas that dividend investors can invest in and do further research on if they don't want to invest in the model portfolio. So again, the goal is really to provide the education and tools necessary to analyze, research, and manage a successful dividend portfolio. And what differentiates the AAII dividend investing model portfolio? It is quant-based, like I talked about. There's over 40 screening characteristics, where if you think back to the Dividend Aristocrats, there's maybe a handful. There's the 25 years and criteria, and there's also the other one where it has to be a component of the S&P 500 index. One of the other things, we have fewer holdings. We hold 24 dividend-paying growth stocks. You saw in the other ETFs, there's 64 for the Dividend Aristocrats, and the Vanguard Dividend Appreciation, I think they held well over 180 some holdings. And 24, there's been numerous studies that is still a good level that gives appropriate portfolio diversification. We have holdings, financials, industrials, technology, healthcare. We've had energy, and we've had utilities as well. A few of the other things, one of the big difference is we use the valuation metrics. And again, the primary one used by dividend investing is the dividend yield. We talked about some of the buy and sell signals. I would say that's one of the biggest difference between our service and some of these ETFs. Now they have proprietary screening characteristics as well, but I've really never seen anything related to valuation. So we want to make sure that the companies in our portfolio, when we add them to the portfolio, we're adding them at an attractive valuation based on their historical dividend yield. A few other things, we require 7 years of consecutive dividend increases, and we think that gives us an advantage. Some of these biotech and technology companies, they're, in terms of the dividend paying life cycle, they're still relatively new. So it's provided us access to some of these companies. One of the companies in the portfolio is Amgen. It's a biotech company, ticker AMGN. And we also have a technology company that's had strong performance since we added it to the portfolio. That's Texas Instruments, ticker TXN. And typically we have a higher yield, especially compared to the Dividend Aristocrats. Our current yield for the portfolio is 3.8% versus 2.66% for the Dividend Aristocrats. A couple other things is we seek total return. So we are looking, it is a dividend and income focused strategy. So we're looking for total return, we're looking for dividend income, and we're looking for capital appreciation as well. One What else can I say? A couple other things. I know for joining today's webinar, there is a special offer to try the AAII Dividend Investing service. I think there'll be some more information on a later slide, and we really look forward to having some of the members joining us tonight, trying out the service. So with that, I think just to wrap up, I wanted to touch on a few things in the appendix. I get asked a lot, hey, what resources out there for dividend investing? So I just listed a few here. I use dividend.com quite a bit. It has a lot of dividend data. It has great dividend investment tools, and it has lots of dividend-focused articles as well. Morningstar, it has independent research and analysis. It also looks at stocks, ETFs, and funds. And Seeking Alpha, it has new investing ideas. It covers a lot of analysis, and it has investment tools and a lot of news. And that's actually the tool that I use to get up to speed quickly on a company. Now, it is a site where anyone can submit an article, and it does go through an editing process. So with that, there are some better articles than others, but I think it is a good way to get up to speed quickly on a company. So it's one of the tools I use in my dividend investing. And then one of the articles here, I thought it was an interesting article. It was from Barron's, and it was called the 40 stocks in the S&P 500 with the safest dividends and 40 that could be at risk. Again, these aren't recommendations, but I think it is a good starting point for looking at potential ideas to do further due diligence on, or stocks that, hey, maybe I should avoid these. And lastly, a couple other things. There's a Goldman Sachs touts safe bets. This was another article that I found. This one was from Bloomberg, and I have the link there at the bottom, and it just gives 40 of their picks that they think are safe dividends, and it talks about some of the criteria they use. And then Jefferies had a list of 60 companies that are susceptible to a dividend cut, and they used a lot of the metrics that we talked about tonight. They looked at the dividend yield, they look at the dividend coverage ratio, and they also looked at the net debt to equity. Again, important metrics to look at to see if a company's dividend is sustainable or not. And lastly, we have the complete list of the holdings in the Dividend Aristocrats. And I mentioned the S&P 500 Dividend Kings. These are the 30 companies that are passing as of April 21st. So with that, I just want to thank everyone for joining tonight. I hope you learned something about dividend investing. Definitely feel free to reach out to me if you have any other dividend investing questions. We are putting together a list of show notes, and I'm happy to include my email if you want to reach out to me directly with any dividend investing questions.
Well, thank you so much. So I guess we'll have all that information will be sent out to everybody who registered for today's webinar, and so we'll get all the information, the links that are mentioned, the links to the presentations and handouts as well. So thank you so much. Do you have time for any more questions, or are you ready to just call it a night?
I can take a couple more, definitely.
Okay, I've got two technical questions here. So what it really has to do, I think, with the notion of if I buy a common stock and I want to capture the dividend, are there any days I need to take a look at or be concerned with?
Yeah, definitely. It's really important to know your dividend dates. And so there are 4 key dates. The first one is the declaration date. Now, this is the date that a company announces their quarterly dividend. There's also the record date, and there is the ex-dividend date, and then the payment date. And of those 4 dates, the most important is the ex-dividend date. And this is important for a couple different reasons, but the number one is if you want to receive the dividend you have to own shares of a company before the ex-dividend date. That will ensure that you receive the dividend income when it is paid. If you purchase shares on the ex-dividend date, you would not benefit from the dividend.
And then only the stock price drops by roughly the amount of the dividend distribution. And that's true whether it's a stock or even a mutual fund. The mutual funds also go ex-dividend, and often you'll see dramatic drops, especially towards the year end. And which brings me to my last question here tonight, and it's has to do with any kind of benefits to, you mentioned a lot of ETFs as opposed to traditional open-ended funds. Are there any tax benefits or benefits to holding ETFs versus traditional open-ended funds?
Oh, you asked me another tax question. You had to end it on a tax question, huh?
Well, I know you love tax. Everyone loves paying taxes, but I'll tell you, this is my understanding. It has to do really with how ETFs versus open-ended funds are structured. And typically speaking, I know they're both pass-through type instruments. A open-ended mutual fund really has to pass through all the accumulated capital gains and losses every year to its shareholders. But ETFs can make use of different kind of methodology, and typically speaking, ETFs are more tax efficient and don't have to deal with capital gains distributions really as much as open-ended mutual funds do. That's my bit of information. That's my bit of knowledge. I guess the true expert in-house, and I should have known better, is Charles Rapla, because he's the one that puts together the AAII annual tax guide. So we'll be sure to have Charles do a presentation here early in May so that we could toss him dividend questions.
Absolutely. Ask him all your dividend tax related questions. I'm sure he'd be happy to answer those.
Well, with that, I guess, thank you so much for your presentation. It was very enlightening. I know I enjoyed it. A lot of good feedback I'm getting from our members on the chat area. And I'd like to encourage everybody to also sign up for future webinars. This coming Monday, we have a very special a town hall with the Securities and Exchange Commission. We're going to have actually the chairman of the Securities Exchange Commission, as well as Lori Schock here to answer all your questions. And it's a great opportunity for you as individuals to express your concerns, your fears, your comments on what they'd like to have improved upon as an investor. I mean, the SEC has a dual mandate. They're here to help protect the individual investor as well as help to create good financial markets. And they love to hear from the retail investor, us, as far as what's the best way to take advantage of information and how to make sure we're protected as far as disclosure is concerned. So again, go to the community section of our website. You can sign up there, and email should be sent out as well. And then also on May 6th, we're going to have Wayne Thorpe doing a presentation. I know you mentioned A+ Investor a number of times during your presentation, and we've made all those features available to all members during this time of market stress so that people can do a deep dive. One question I had here was from someone: how can they find out how much cash a company has on its balance sheet? Well, you can look that up in a company report here on our website. You could also go to the company's investor relations area to get that information. So I encourage everybody to keep abreast of the information. Derek, thank you so much for a very informative webinar. And again, Ryan, thanks for being a wonderful producer, and our audience for tuning in and giving us some questions that even Derek can't answer.
Thank you. Thanks for joining.
Pleasure. Good night.